Good day, everyone. Today we are discussing the last topic of our group, accounting for derivatives. Meet the masterminds. I'm Tamara Kashmir Gayo, together with Ms. Jean Pilapil, the last reporters for Intermediate Accounting 2. Before we start the discussion, here's the objectives for this lesson. Introduction. In conducting their operations, entities are exposed to a lot of risks. Part of this is the huge fluctuations of the selling price of an entity's products and expenses. As such, an entity may use derivatives to manage the level of volatility through the process of hedging. Some entities may also use derivatives for speculative purposes, where they bet on the future movements in the price of financial assets or commodities. So we all know that having a business involves a lot of risks, like currency and interest rate risk. So sa business, kailangan nyo ng mechanism para ma-mitigate yung mga risk na to, and that is through entering derivative transactions. So may dalawang main purpose ang financial derivatives gaya na nabanggit dito. These are hedging and speculating investments. So hedging will be further discussed sa higher accounting subjects, but for your background, hedging means countering or minimizing risk of adverse price movements through entering such contract. For example, si country A ay nag-i-import ng goods from country B. Then nag-worry si country A about currency exchange rate fluctuations kasi baka mag-incur sila ng losses because of the currency uncertainty. So para ma-minimize yung risk na to, pwede silang pumasok sa isang contract wherein ilalak nila yung price ng goods sa specific exchange rate for a future date. Speculating, on the other hand, involves taking higher risks for higher returns. So kung sa hedging minimize yung risks, dito sa speculating is mas nagtatake sila ng risks. For example, na-anticipate ni company A na magkakaroon ng price increase in the future, so ngayon palang bibili na siya ng additional inventory para mas makatipid and makagain ng higher returns. Paano? So since mas mura niya nabili yung inventory, pwede niyang ibenta yun ng mas mahal. Then dun siya kikita. So that is how hedging and speculating works. But for now, the focus of this chapter is for speculative purposes. So I know you guys already have knowledge of derivatives, but before we define it, discuss muna natin yung characteristics na meron nito. First, its value changes in response to the change in one of the following. So magbavari daw ang value ng derivatives based sa value ng tinatawag nating underlying. The underlying, ito yung kung saan nakabase yung contract nyo, pwedeng commodities, stocks, bonds, interest rates, etc. Meaning, if may changes sa value ng underlying, magbabago rin yung price ng derivative. Second, it requires no initial net investment or initial net investment that is smaller. So hindi kailangan ng initial net investment sa derivatives, mainly because dinaderive nga yung value niya sa underlying asset. And third, it is settled at a future date. So businesses use derivatives to manage risks that might happen. Hence, it is safe to say na sinasettle siya sa future. Now, here's the definition of derivatives. So derivative is a contract whose value is derived from the changes in the performance of the underlying that will be settled in the future. So we have three kinds of derivative contract. First is the future contract. So it is an agreement to buy or sell an asset at a predetermined price on a specified future date. Tapos yung terms and conditions ng future contract ay standardized and traded on regulated exchanges, meaning may set na rules sa public. With that, matatawag natin siya as MTM or mark to market. It means that the underlying is subject to daily price fluctuations. So as much as may daily changes sa market, magre-reflect yun sa contract. Second type is forward contract. It is an agreement between two parties to buy or sell an asset at a specified price on a future date. So as you can notice, same lang sila ng future contract. The key difference lang is that forward contracts are customizable private agreements. So the specific terms of the contract are agreed upon by the parties involved. Hindi ito nakadepende sa market. Instead, it is traded over the counter, meaning once lang sila settle, unlike sa kanina, settle siya every time may pagbabago. And lastly is the options contract. So it is a financial agreement that grants the buyer a right to buy or sell an underlying asset at a predetermined price within a specific period. For example, gusto mo mag-invest o bumili ng stocks ni Company A. Pero syempre, ayaw mo agad-agad mag-commit. Now, napagdesisyonan mo na bumili na lang ng call option wherein magkakaroon ka nga ng right na bumili ng stocks ni Company A at a specified price o tinatawag nating strike price within a specific period. If in case mas mataas yung market price ng stocks ni Company A kaysa sa strike price, pwede mo i-exercise yung option mo to buy kasi mas mura mo siya magbibili. This option is called in the money. However, if mas mababa yung market price compared sa strike price, pwede mong hindi i-exercise yung option mo to buy stocks and hayaan na lang na ma-expire yung call options mo. This option is called out of the money because hindi naman profitable na bumili ka ng stock sa mas mahal na presyo compared sa market price. So that is how options contract works. So here are some notes regarding future forward and options contract. In a future forward contract, an entity is required to abide by the contract's terms and conditions, whether its position in the contract is advantageous or disadvantageous. In an option contract, the holder may choose not to exercise the option if it is in a disadvantageous position. So we have four elements of a derivative contract, namely underlying, exercise price, notional, and maturity. Underlying na pag-usapan na natin kanina, it is where the value of derivative is based. Exercise price, ito yung fixed amount na mabibili or marireceive ng entity in buying or selling an underlying. Notional, it represents the nominal amount over which the derivative contract is based. So nakukuha siya by multiplying the quantity of underlying by exercise price. Maturity, basically the date of settlement. So here's an illustration that contains the elements of a derivative contract. On November 15, 2023, an entity, a speculator, entered into a forward contract for the purchase of 100,000 kilograms of a commodity for 50 pesos per kilogram. The parties will settle the contract on January 15, 2024. So, i-determine natin kung alin dito yung elements ng derivative contract. The underlying is the 100,000 kilograms of that commodity. Exercise price is yung 50 pesos per kilogram. Notional, 100,000 times 50 is 5 million pesos. And the maturity date is January 15, 2024. So let's now proceed sa manners of settling derivative contracts. We have two, the physical settlement and the net cash settlement. So sa physical settlement, upon expiration ng derivative contract, the parties involved exchange the underlying asset itself. For example, in a futures contract for crude oil, if the contract is held until expiration, i-deliver ni seller yung actual barrels of oil kay buyer, while si buyer babayaran yung agreed upon price nila. Net cash settlement naman, it involves the exchange of cash based sa value ng underlying asset, rather than the physical delivery of the asset itself. Instead na may actual transfer ng asset, isisettle na lang by exchanging cash amounts na equals the difference between the contract specified price and the market price ng underlying asset at the contract's expiration. So here's the general accounting model for derivative products. Bago tayo mag-account ng derivatives, titignan muna natin kung may apply ba natin si PFR PFRS 9, and it is by answering a few questions. First is, does the derivative contract have financial asset as underlying? If the answer is yes, then the PFRS 9 applies. If no, there's another question. Can the contract be settled net in cash or by exchanging financial instruments? If still yes, then the PFRS 9 applies as well. If no, then the contract is out of scope of PFRS 9. So let us briefly discuss PFRS 9 first. PFRS 9 serves as a guideline for accounting for financial instruments including derivatives. Kaya it is important na masagot muna yung questions dito bago i-apply ang accounting method na pinrovide ni PFRS 9. Pwede kasing i-measure si derivatives through two methods, which are the fair value through profit or loss and hedge accounting. So dito yon. Paano natin malalaman kung ano yung gagamitin? It's by answering these questions. First is the derivative contract held for speculation? If yes, then it is accounted for at fair value through profit or loss. If no, another question, is the derivative contract designated for hedging? If no, then it's still accounted for through FVTPL. If yes, then the hedge accounting applies. Now let's proceed to determining the payoff from forwards or futures. So before anything else, when we say payoff, it refers to the profit or loss from an investment or financial transaction. Ito yung kung may net gain ba or net loss, ganyan. So these are the guidelines in determining payoff. First, it is important to understand the role of the entity and the relationship between the current forward and or future price and the exercise price of the underlying. Yung role na tinutukoy dito is kung buying or selling entity ba si yung parties. Second, take note that the forward or future price is still a better amount to be used since it reflects all other risk in the contract. When we say forward or future price, it's the buying or selling amount in the future. Pag spot price, ito yung immediate buying or selling amount. Third, again, for forwards and futures, the entity is required to abide by the terms and conditions. So it is possible that the entity will either be at advantageous or disadvantageous position as follows. So under buying entity, if forward or future price or spot price is greater than exercise price, ang position niya is advantageous. Bakit? Kasi ma-acquire niya si underlying asset at a lower cost. Pero if mas mataas si exercise price, then he is at disadvantageous position. Under selling entity naman, if forward or future price or spot price is greater than exercise price, then he is in disadvantageous position. Kasi kailangan ni seller i-let go yung asset at a lower price. However, if mas mataas si exercise price, then he is at advantageous position. For you to be able to further understand the payoff, here's an illustration for you. On December 1, 2023, ABC Company and XYZ Company excuse me, entered into forward contract where the former will buy from the latter 10,000 ordinary shares of another entity at a forward price of 30 per share. Required to determine the position of each of the entities involved. The current forward price is 35 pesos per share as of December 31, and the current forward price is 27 per share as of December 31. So before anything else, according to our guidelines, i-determine muna natin yung role ng parties. Sino si buying entity at sino si selling. So dito si ABC Company ang buyer, while si XYZ naman ang seller. Sa scenario 1, tumaas ang forward price from 30 to 35. So based on our table kanina, if the forward price is greater than the exercise price, which in this case is 30 pesos, nasa advantageous position si buying entity o si ABC Company kasi mabibili niya ng mas mura ang bawat share. While sa XYZ Company, ay nasa disadvantageous position since wala siyang choice but to sell its shares for 30 pesos each instead na 35. In our second scenario naman, the forward price decreased to 27 per share. In this case, forward price is less than the exercise price. Hence, si buyer ay nasa disadvantageous kasi instead na 27 na niya lang mabibili, 30 pesos pa rin since yun yung agreed upon price nila. Yung si seller naman ngayon ang nasa advantageous position for being able to sell it at 30 instead of 27. So based on the above scenarios, we can say na ang position ni buying and selling entity sa loob ng derivative contract ay mirrors ng isa't isa. Kumbaga, if si selling entity ay nasa advantageous, si buying entity naman is at disadvantageous position and vice versa. Okay, since we're done with the foundation for derivatives, specifically forwards and futures, it's time for us to learn about its accounting. I prepared 4 guidance again on how forward and future contracts are accounted. First things first, identify the position of the entity, whether it is at advantageous or disadvantageous position. If advantageous, then the amount to be recognized is forward or future asset. If disadvantageous, then the amount to be recognized is forward or future liability. Now, since na-determine na natin kung ano yung amount na i-recognize, let's see kung paano naman siya i-measure. So, pag given si forward or future price, the measurement will be current forward or future price less original forward or future price multiplied by quantity of underlying. If si spot price lang ang given, spot price less original forward or future price multiplied by quantity of underlying. Next are the consequences of changes in the fair value of forward or future asset or liability sa profit or loss ni entity. If merong increase sa forward or future asset, then the amount in profit or loss is unrealized gain. If decrease naman, unrealized loss. If there's an increase in forward or future liability, there's an unrealized loss. If decrease naman sa future or forward liability, then there is unrealized gain. Lastly, on the day of settlement for derivatives entered into for speculative purposes, the party at the disadvantageous position is required to make a cash payment to the party at the advantageous position. Okay, now we're done with the discussion of accounting for forwards and futures. Let's have some illustrations for you to see how it works. On November 10, 2023, Alpha Company entered in a forward contract with Beta Company for speculative purposes involving Alpha's purchase of 15,000 barrels of petroleum gas at a forward price of 80 pesos per barrel. The settlement date is set on January 20, 2024. By December 31, 2023, the prevailing forward price amounted to 90 pesos per barrel. Fast forward to the settlement date, the forward and spot price are equal to 93 pesos per barrel. The parties intend to ultimately make a net cash settlement. Time value of money is deemed immaterial. Required determine the journal entries to be recorded in the books of Alpha and Beta during 2023 and 2024. Okay, let us again determine first who is the buyer and who is the seller. So, in this case, si Alpha Company ang buyer, si Beta Company ang seller. So, the commencement date is November 10, 2023. Wala tayong entry dyan since wala namang changes sa forward price na 80 pesos. However, on December 31, the forward price increased to 90. And according to our guidelines, i-determine muna natin kung sinong nasa advantageous at disadvantageous position. Since 90 is greater than 80, ang nasa advantageous position is the buyer. And nakalagay sa table natin kanina na if advantageous, the amount to be recognized is forward asset. And its measurement ay by getting the difference between the forward price and the exercise price multiplied by the quantity of the underlying. So 90 minus 80 multiplied by 15,000 is 150,000. And since nag-increase na si forward price, the amount in profit or loss ay unrealized gain. Our entry will be debit forward asset 150,000, credit unrealized gain 150,000. And remember, ang position ni buying and selling entity sa loob ng derivative contract ay mirrors ng isa't isa. So kung forward asset kay buyer, forward liability ang re-recognize ni seller. Kung unrealized gain kay buyer, unrealized loss kay seller. So repeat the same process lang susunod na entry for January 20. Here ang na-compute natin na unrealized gain ay 195,000. But since na-recognize na natin yung 150,000 last entry, ipagmaminus natin yung dalawa. So 195,000 minus 150,000 is 45,000. So our entry will be debit forward asset 45,000, credit unrealized gain 45,000. And lastly, it is stated that this contract is for speculative purposes. So there will be a net cash settlement wherein the disadvantageous party will make cash payment kay advantageous party. The entry will be debit cash 195,000 and credit forward asset 195,000. Let's have illustration 4. On October 1, 2023, speculating to decline the price of copper ore, Delta Company entered into a forward contract to sell 20,000 tons of copper with Gamma Company at a 40 peso forward price. Settlement date is set on January 31, 2025. Forward prices and spot prices are the following. Required, determine the journal entries to be recorded in the books of Delta and Gamma during 2023 to 2025. So dito given si forward prices at spot prices. But remember, sabi ko kanina na forward or future price is still a better amount to be used since it reflects all other risks unlike spot prices. Hence, ignore natin dito. Let us again determine who is the buyer and who is the seller. In this case, Delta Company is the seller, while Gamma Company is the buyer. So on October 1, there will be no entry since walang changes sa forward price. However, on December 31, forward price has decreased to 32. In this situation, ang nasa advantageous position is si seller kasi he will be able to sell it at 40 instead na 32. So the amount to be recognized ay forward asset. And its measurement is computed by getting difference of forward price and exercise price multiplied by quantity of underlying. So 32 minus 40 times 20,000. So we'll get 160,000 as the measurement. And our entry will be debit forward asset 160,000, credit unrealized gain 160,000. Again, ang position ni buying and selling entity sa loob ng derivative contract ay mirrors ng isa't isa. So kung forward asset kay seller, forward liability ang i-recognize ni buyer. Kung unrealized gain kay seller, unrealized loss kay buyer. Repeat the same process up to the last change sa forward price. In our last entry, in this case, ay the net cash settlement. Since the buyer or si Gamma Company ang nasa disadvantageous, it is required to make a cash payment kay Delta na nasa advantageous position. So the entry will be debit forward asset 30,000, credit unrealized gain 30,000, debit cash 100,000, and credit forward asset 100,000. So that's the end of my part. May I now call on Miss Jean Pilapil to continue the discussion.